There is a quiet war being fought over your retirement, and the people fighting it would rather you never noticed. Because the moment you understand what is really happening between gold and the dollar right now, you start asking questions the big banks and the financial channels have spent your whole life training you not to ask. So let me say it plainly, the way a friend would say it across the kitchen table. Gold broke out. The dollar broke down. And those two things are not a coincidence. They are the same story, told from two different ends. If you are sitting on $100,000 or more in a retirement account, and that account is stuffed with the same paper the whole crowd owns, this is about you, not someday, now. Because the value of what you saved is measured against a currency, and that currency has been quietly slipping. And the one asset that has been rising while it slips is the one nobody at the bank ever put in your plan. By the end of this, you are going to understand why that happened, who is buying while you were told to relax, and what the smartest, most conservative institutions on the planet did the moment they got scared. That is the part one I am saving for last, because it is the part they will never show you on the evening business report. So here is your first real fact, and it is not a price, because prices come and go. It is a mechanism, and mechanisms do not lie. Gold and the dollar used to move like two ends of a seesaw. When the dollar got stronger, gold got weaker. When real interest rates rose, when a government bond finally paid you something after inflation, gold was supposed to fall because gold pays you nothing. It just sits there. That was the rule every trading desk lived by for decades. And recently, that rule broke. Gold climbed while the old math said it should have dropped. The seesaw stopped working. When a rule that reliable stops working, it does not mean the world went crazy. It means something underneath the world changed, and the people at the top figured it out before you were told. Now, why would gold and the dollar break apart like that? To answer it honestly, I have to take you to the real story this entire video is built on, and it is not ancient history. It happened in this decade. A major power on the world stage saw a large portion of its foreign reserves frozen. Not spent, not lost in a market, not stolen by a thief in the night. Frozen, locked, rendered untouchable by the stroke of a pen in another country. Now, I am not here to argue the politics of that. Set the politics completely aside. What matters for you and your savings is the lesson every other central bank on earth learned that same week, and they learned it fast. Here is the lesson, and it is the hinge of everything. A country can hold its wealth in another nation's currency and another nation's bonds and feel perfectly safe, right up until the day the country that issues that currency decides it is no longer yours. Reserves held as somebody else's promise can be switched off. But gold, real gold, the kind you can weigh in your hand, sitting in your own vault inside your own borders, cannot be frozen by anyone. It answers to no other government. It needs no counterparty's permission to still be worth something in the morning. That is the whole point. And every finance minister and central banker watching quietly ask themselves the same question you should be asking about your own retirement. What do I own that nobody else can turn off? And they did not just wonder, they acted. In the years since, central banks bought gold at a pace we had not seen in generations. For several years running, the world's central banks bought over 1,000 tons of gold a year, roughly double what they had been buying in the decade before. Think about who these buyers are. These are not day traders chasing a hot tip. These are the most cautious, most deliberate, most boring institutions on the face of the earth. They move slowly, they answer to nations, and they collectively decided, quietly and all at once, to trade a portion of their paper promises for metal they could lock in their own basements. That is not a trade. That is a verdict. Let me make sure the scale of that lands, because the financial media works very hard to keep it feeling small and technical. Gold has now climbed past the point where it overtook the euro to become one of the largest reserve assets held by central banks on the planet, second only to the dollar itself. Read that again. The world's official institutions, when they sit down to decide what real money is, now put a bar of gold ahead of one of the largest currencies in existence. Nobody rang a bell when that happened. There was no breaking news banner. Because a banner like that would make you, the ordinary saver, start wondering why your own retirement holds none of it. And that is exactly the fear I want to pause on, because it is the honest one. If the most careful money on earth is quietly moving toward gold to protect itself from a world where paper can be switched off, and your entire nest egg is still sitting in that same switchable paper, then you are carrying a risk you were never told you were carrying. Not because you did anything wrong. You followed the plan they handed you, but the plan was written for a calmer world than the one we are living in now. So here is the part one promised would be useful, and I am going to keep it short and then get right back to the story. Those same central banks are buying gold at a record pace, and there is a perfectly legal, quiet way for an ordinary American retiree to do the exact same thing inside the account they already have. You can move a portion of your retirement savings into physical gold and silver, real metal, without triggering taxes and without triggering penalties, using a structure called a self-directed precious metals IRA. It is not exotic, and it is not just for insiders and the ultra-wealthy. If you have $100,000 or more in any retirement account, a 401k, an IRA, this is for you, the same way it is for them. I put together a free guide that walks through exactly how it works. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. That is jeffreedguide.com. Look it over, and then come right back here, because the next part is where it gets clearer. Now let me tie this back to the title, to why the dollar broke down at the very moment gold broke out. Because these are not two events. They are one event seen from both sides. When the guardians of the world's reserves quietly decide they want less of your currency and more of something no one can freeze, that is, by definition, less demand for the currency and more demand for the metal. The dollar weakening and gold strengthening are the front and the back of the same hand. The financial channels will give you 10 different daily reasons for each move, a jobs number here, a soundbite there, and every one of those reasons ages out by the following week. The structural reason does not age. The structural reason is that the world is quietly rebalancing what it trusts. And it goes deeper than one frozen account, because that freeze did not create the anxiety, it revealed it. Underneath sits a mountain of debt. Government debt, at a scale the human mind genuinely struggles to hold, growing faster than the economy that is supposed to service it, with the cost of simply paying the interest climbing to levels we have not seen in decades. When a nation owes that much, there is a powerful, permanent temptation to let the currency quietly lose value over time, because a shrinking dollar makes a giant debt easier to carry. Nobody announces that. No one stands at a podium and says, "We intend to erode what your savings are worth." But the incentive is baked in, and gold has been sniffing it out. Gold is not reacting to one headline. Gold is reacting to the arithmetic. And notice what has not calmed it. The people who set interest rates could, in theory, be gold's great enemy. When a central bank raises rates high enough and holds them there, it can crush gold for years, because suddenly cash pays you handsomely to sit still and wait. We have seen that happen. There was a time when a determined Fed chair took rates into the high teens and broke gold for the better part of 2 decades. That is the one force that has ever truly tamed the metal, a bond that pays a real return you can actually believe in. So look at the present through that lens. We have had a Fed that is anything but soft. The current chair, Kevin Warsh, is no dove, and the Fed's latest decision came out of a genuinely divided room, with policymakers split and some pushing to tighten further rather than ease. Rates have not been near zero, and still gold has climbed. When the metal shrugs off the one thing that has historically beaten it, that is not noise. That is a market quietly voting that it trusts the metal more than it trusts the promise, even when the promise is paying. The financial channels will not frame it that way for you, of course, because their whole business depends on you staring at the daily wiggle instead of the decade-long tide. They will tell you gold moved because of a single soft number, or a single hot number, or one official's remark caught on a microphone. And every one of those explanations is designed to shrink the story down to something that feels temporary and reversible, something you can safely ignore until next week. But the tide does not care about the wiggle. The tide is the arithmetic of the debt and the memory of the freeze, and it has been coming in for years. Here is where I want to grab you by the shoulder for a second, because the middle of a story like this is where most people drift, and this is the part that actually changes how you should think. Watch what gold has been ignoring. For most of modern history, when a government bond started paying a real return after inflation, gold would sag. Because who wants a metal that pays nothing when a safe bond finally pays you something? That was gold's one true enemy, a bond that pays you to wait. And lately, gold has climbed anyway, straight through the teeth of that old rule, as if it no longer believes the return is real, or no longer believes the promise behind the bond is as solid as it used to be. When gold stops fearing the one thing it always feared, you should sit up. That is the market telling you something the anchors are not. Let me be very fair here, because I am not in the business of scaring you, and there are people online who are. Gold does not go up in a straight line, and anyone who tells you it does is selling you a fantasy, not a plan. We have watched gold do brutal things inside a long bull market before. Back in the middle of the last century's great gold run, there was a stretch where the metal fell by nearly half, cut down the middle, in the very heart of a bull market that would go on to multiply many times over from there. Imagine holding through that. Imagine the people who sold at the bottom of that drop, certain it was over, only to watch it climb for years afterward. That is the emotional test. The metal was fine. It was the holders who broke. So when I say own gold, I am not promising you a smooth ride. I am telling you the ride is worth it, only if you size it so a scary drop can never force you to sell. And this is where the enemy in this story shows its hand, because the drops are not always what they look like. The people who run the exchanges, the trading desks, the ones who profit when you churn, they have tools most retirees have never heard of. They can raise the cost of simply holding a position, the margin, and force a wave of selling that has nothing to do with the metal being worthless. We have seen silver drop by roughly a third in a matter of days when nothing fundamental about silver changed at all, driven by the exchange lifting the cost of holding it. Nothing about the outs changed. Only the cost of clinging to a paper claim on it changed. And every retiree who got shaken out in that panic sold their metal to somebody patient and well-funded who understood exactly what was happening. Now, ask yourself who that patient buyer usually is. It is not the little guy. That is the difference between owning the metal and owning a promise. When you hold the paper version, a claim, a certificate, a position on a screen, you are exposed to every one of those games. The cost of holding can be jerked around. The claim can be diluted. In a real panic, you can discover that far more paper claims exist than there is metal to satisfy them. But when you own the physical thing, held properly on your behalf, sitting in a vault with your name on it, none of those levers reach you. You cannot be margin called out of a coin you already own. That is the whole reason the central banks wanted metal in their own vaults instead of promises in someone else's system. They wanted the version nobody could pull the rug out from under. You deserve the same version they chose for themselves. Now, here is the beat I most want you to hear, the one the whole video has been walking toward. Where are we in this story? We are early. Not early like it just started, but early in the way that matters, the way that pays. The smartest, most conservative money on the planet, the central banks, already sees it and is already positioned. They moved years ago, and they are still moving. But the mainstream, the pension funds, the financial media, the neighbor who tells you gold is a relic, the advisor who has never once mentioned it, they have not caught on yet. And that gap between what the smart money already knows and what the crowd has not yet realized is the entire opportunity. Because by the time it becomes obvious, by the time gold leads every news segment and every advisor finally recommends it, and your brother-in-law is asking how to buy some, the easy part will already be behind us. Nobody sends you an invitation to be early. There is no phone call. No headline that says, "This is the moment, act now." You either see it before the crowd or you arrive with the crowd, and the crowd always pays the highest price. So let me be as honest with you as I know how to be, because you have earned it by staying this long. Nothing I have told you is a promise of a price or a date. I cannot tell you what gold does next month, and anyone who claims they can is lying to you. Volatility is real. The drops are real. And this is a case built on structure and history, not a guarantee, and it is not personal financial advice. What I can tell you is how careful people handle it. Own the real metal, not a paper substitute you can be shaken out of. Size the position so a sharp drop is uncomfortable but never fatal, never something that forces your hand at the worst possible moment. And do not sell into the shakeout, because the shakeout is exactly where they take the metal from the nervous and hand it to the patient. Be the patient one. That is not a strategy that requires you to be a genius. It requires you to be calm when others are not. Which brings me back to where we started, and to why I made this whole video. Gold broke out while the dollar broke down, And now you know that was never two stories. It was one. It was the sound of the most careful institutions on Earth quietly deciding they wanted less of a promise that can be frozen and more of a metal that cannot. And the best time to make a decision like that is the moment nothing feels urgent, the calm window when it is still cheap and reversible and entirely your choice, which is precisely the window we are in right now. When it finally feels urgent to everyone, the calm window will already have closed. So here is the last thing, and it is only for those of you who stayed to the end, because you are the ones who actually take your retirement seriously. If you have $100,000 or more in a 401k or an IRA, I would like to offer you a free, no obligation, one-on-one educational web conference. It is a real conversation with a real person about your actual situation, not a sales pitch and not a script. We will walk through how the physical gold and silver IRA works, whether it even fits what you are trying to protect, and how retirees are quietly doing exactly what the central banks did, moving a portion of what they have into metal no one can freeze. To get it, just mention that you watched this all the way through. If you are on your television, scan the QR code on your screen right now. If you are on your phone or your computer, go to jeffreedguide.com. That is jeffreedguide.com. The central banks already made their decision. The only question left is whether you make yours while it is still quiet, still calm, and still entirely up to you.